smiling faces. Okay, Bob, come on up. Bob is with Loans and KC. How many of you know what Loans and KC is and why it's different than other mortgage companies? Can I tell you the number one reason we are exceedingly different? We are, as far as I know, we are the only agent-owned mortgage company in Kansas City. Agent-owned. So you all will have that opportunity. You have to be in the business for 2 years before you would be eligible to buy shares in this company. I did, and in their first year, we got checks. We got checks.
Yes.
Yeah, it was a nice little check, and it made me smile, and I was like, wow. So that is one of the things that we as a company that David is very passionate about, is finding other ways for our agents to invest and to have income. Because just like a real estate brokerage needs other streams of income, like a mortgage company, down the road we'll have our own title, down the road we'll have our own insurance. You as agents need other streams of income too. So, Bob, you want to just a little bit about you and then jump into everything that a new agent needs to know about loans.
Howdy y'all online. Sorry if I ignore you. I'm gonna, because I'll forget. Kristen will remind me. I think I've given everyone in the room a card. My name is Bob Ludwikuski. Yeah,
Say that.
anyways.
5 times.
And I want to start with a joke. If you answer it correct, you'll be the first winner. We will have a few winners this morning. Winners get swag. When does a joke become a dad joke?
Anytime a dad takes.
When have you done
Yes! When it becomes a parent. It's a great one. It's a great one. It's a great one. Okay, what I would love to do, I'm gonna
Yeah.
introduce myself a little bit, just very short, and then I'd love to go around the room if you could just give me like 5 seconds, like name, what you did before real estate, and if you have a joke, I need some new ones. I would love a joke. Okay, I'm Bob. I started out my life as a teacher, and then I had kids and was poor and needed to make money. And the only person in the building that I worked in that made money, or I thought made money, was the principal. So I became a principal. I was a principal for 5 years. And then I had more kids and I was still broke. And I realized that no one in any of these buildings makes any money. So I got into sales. And in sales, I learned that if you are good at sales and you can find a product that makes a lot of money, you can make a lot of money. And at first that was cars and then insurance. And then my brother invited me over to the lending world, and I love it. It's very volatile, kind of stressful, but there's plenty of money if you do it well and do it right. We do it well. We do it right here at Loans and KC. So I'll tell you that. Currently in the office, it's just me and Elise. Elise is in some training and she is licensed, but I'm the only loan officer if you have actual loan questions and things like that. So come to me anytime. If you want more cards, I would love you to hand them out to all your friends and family or whatever. I have plenty of these, they're cheap. Okay, we'll start here at the front. Name, what you did before here, and if you know a joke, that would be great.
My name is Doug McCorkle. I'm a licensed plumber now, and I've been here for about 6 months, and no joke.
No joke. All right, all right.
My name is Amy Wilkins. Mom of 3, that was like my primary job. They're now teenagers. But I did part-time weddings, professional organizing, and HR.
Awesome. People skills will come in handy for sure.
Yeah.
I'm Ashley, this is the whole time now, but I was previously in nonprofit fundraising and event planning. On 2, and born and raised right a mile away from here.
Also no jokes.
Oh, why does Santa Claus like to garden?
I don't know.
Because he loves to help.
One of my favorite jokes is the Christmas joke, but it's really dirty, so
Oh, no.
talk to me outside, yeah. Yeah, after class.
This is recorded.
I'm Tina, and I'm very new here. I'm on the Austin Short Group team of Amy, and my job before this was I helped run a small business, and it was a mobile bartending service. And so we helped do like a bunch of events and things like that. And so it was a lot of networking and stuff. So it was a great learning experience. A joke that we say in my family is what's brown and sticky.
Oh,
Right?
I don't know.
A stick.
Ah, all right.
But you'd be like, what's green and bushy? A bush.
Birthday boy.
Terry, before this, I make the field tomorrow after about 24 years. This is full time. Now.
Kick well.
Yeah, and
Okay.
I'm Danielle. Before this, I was in college, but didn't go to retail, finished full time, going to school. Moved to California, and people business city. The last summer, you can usually hear it in my voice, I usually get asked, but I come to say. But, we get so far.
Awesome. I think this is one of those fields, I mean, I don't know, Kristen would know better than me, but that if you get in young, man, you can really establish, you have a lot of time to establish yourself and you can kill it. I had no idea how successful real estate agents could be till I started working here. So many people in this office I admire so much because of what they're able to do for themselves. So, Angel, you want to introduce yourself? Or are you just visiting?
No,
Angel, I'm one of the launch coaches. How are you?
Okay.
I am Skylar. I am a stay-at-home mom. Great at the time. All of my pictures are in.
Ah, what language?
Some of my favorites are Spanish. I like some sign language fun.
Hablo español yo.
¿Cómo se dice un zapato en inglés?
Shoot.
Salud.
All right,
I like that.
all right.
So Jeff Nelson, and, I'm in medical sales. Been doing that. So whiting cows, where cows,
All right.
because it wants no part.
Love it, love it. Just solidifying your status as the victor of the joke game. Megan?
I'm Megan, I'm one of the launch coaches here for real estate. I manage my mother's law firm. Very probably.
You know, buying houses, pouring booze, getting divorced, these are all things that bring people joy. So I'm glad that we're bringing joy to people. And divorced people need houses and divorcing people need booze. So there's like some connection to all three of those as well. Okay, here's my plan for this time. I'm gonna just kind of touch on what mortgages are, what the different types of mortgages are, what we would love for you to be as an agent in your relationship with your lender, whether that's us or anyone else. And then I've got some scenarios that I want to play with, and I have kind of like some quiz stuff that we'll just go through, that if you're able to follow and answer the questions, you'll know mortgages way better by the end of this hour than you did before. Okay, so I would like you to take some notes while you're doing this. If you want to do it on your computer, that's fine. If you want to write it down, that's fine. And we'll go kind of quickly here, just so that we're all on the same page. First of all, mortgage itself, the word mortgage. What is a mortgage? What's a definition of a mortgage?
A loan
It is a loan. Good.
on a house.
What's a loan on a house? That's probably as simply as you could put it. Very good, Connor. It is a loan used to purchase real estate or refinance real estate, where the property itself is collateral. And when we say the property, we mean a house. Okay, if you get a loan against a farm, that's not a mortgage, that's a land loan. You get a loan against a big building downtown, that's not a mortgage, that's a commercial loan. A mortgage is a house, and the house is collateral. Do we know what collateral is, or should I go into collateral? What does collateral mean? To borrow against, right? So if you miss your payments, whoever lent you the money gets that thing. That's the safety thing. Okay, so it's a secured form of debt. When we talk about debt, we talk about unsecured debt or secured debt. Secured debt means it's tied to something that the lender will get if you fail. If you don't make your mortgage payments 3 days in a row and the bank sends you a letter that says, we get your house, what's that called? That is a foreclosure, right? Foreclosure, good or bad? Very, very bad. Very, very bad. Correct. Okay, principal. What is principal when we're talking about a loan? Probably you're right, but it's too confusing. One other term that I want to start. No, principal could be David Conderman. He's an operating principal, but that's not what I'm talking about.
That's the price of the house.
No, that's purchase price. My loan didn't cover the full price, right? There's a down payment, so it's not the price of the house.
Well, there's principal and there's interest, it's like the actual
It's the money you.
money going down
Exactly.
towards.
If I borrow $200,000, 200,000 is the principal. It's the amount borrowed. Principal is the amount borrowed. And it's also the amount that you have to repay, right? What's interest then? Accumulated, so something's growing, that's correct. What's it growing on? Interest is, when you pay interest, the Bible says it's sinful to charge interest. We forgot that part, we do it anyways. What is?
Pay interest on the principal.
Correct, you pay interest on the principal, so just like your credit card, if you run a balance, you're gonna pay way more than that back unless you pay it off on time. On a mortgage, the interest rate is the amount charged to the principal to you per year that you pay in interest. The more interest, the more expensive your payment is. The less interest, the less expensive your payment is. Principal and interest together are called P&I. Okay, you're gonna hear me accidentally just say P&I as if you know what I'm talking about. But that's a mortgage term, P&I, principal and interest. Principal and interest, P&I together, is the only thing that the lender controls. The only thing that the lender controls. There's a lot of other parts that go into a mortgage that the lender does not control. The P&I is a math equation from your loan amount and your interest rate. Okay, escrow. No, is anyone here from California or ever lived in California? Do you know they don't call it escrow in California? They have a different term. It's called impounds. But what are escrows for all of us other 49 staters, or impounds for the Californians?
It's like the money that's set aside to make payments for insurance and taxes.
Exactly. Escrow means two things in mortgages. 99% of the time, it's exactly what Amy said. It's a little tiny savings account that sits next to your mortgage with your lender, and it collects payments for tax and insurance once a month. And then once a year or twice a year, depending on your county, it distributes those to pay your bills, your homeowner's insurance bill and your tax bill. Okay, that's your escrow account. There's also something called escrow holdback. We probably won't get into that, but it's pretty rare. PMI or MI or mortgage insurance. What is that? You can tell me. Why? Is it just a penalty for being poor like everything else in life? Kinda. What is the danger? No, you mentioned dangerous. What is the danger? Who's the danger to? Who's buying the insurance? I mean, you're paying for it if you're paying for it, but I think you're right. I think I asked it incorrectly. Who is being insured by mortgage insurance? The bank, correct. It is the bank's insurance against you defaulting. So why wouldn't they have it if I put 30% down? Why does the bank not feel afraid that you're going to default if you put 30% down? You ever think about that? Still at risk, right? So you're less likely to default because you put a ton of money down, but what else? What else happens if you do default? Let's say you put 30% down. Let's say a house is 200 grand, you put 60,000 down, and then Worst thing happens, you know, you get in an accident, you can't work, you run out of money, you default. The bank's not as threatened by that as they would if you only put 5% down. Why not? Okay. Correct. The bank, remember, if you default, if you don't pay your mortgage and you foreclose on, it, remember, the bank owns your house. So if you're on a loan where you only put 5% down and then the bank accidentally owns the house, by the way, the bank does not want to own your house. The bank doesn't have the personnel to sell your house or to evaluate your house or to fix your house if it's broken. So the bank doesn't want your house. They want your money. So if you default, then the bank owns something and they're not exactly sure what it's worth and it's a pain in the butt. But if you default and you put 30% down, they already have a ton of equity. They've gained in value a lot more. So it's less of a risk for them because if you default, they come out winning. Whereas if you foreclose with only 5% down, maybe they break even. And so that's a little different. So you're insuring the bank. Good. Okay. Yes.
Like, earlier you said PMI principal and more than principal insurance, but this was PMI bank insurance.
P and I is principal and interest. P and I, yeah, we can say it quickly, so.
Okay,
P and I.
okay, I got you.
Yeah, and PMI is, it's really, we say MI. PMI is private mortgage insurance, which goes along on a conventional loan. But FHA loans have mortgage insurance also, that's just called MI. So MI is a general term for all of it. It's all the same. And then DTI, debt to income ratio. Someone give me a brief explanation of what that is. DTI, debt to income. All right. Debt to income is a ratio that your lender will calculate to determine if your borrower has ATR, ability to repay. That is what the bank is trying to measure. Do you have the ability to repay this loan? If so, let's give you the money. If not, you don't qualify. DTI is the ratio that is used to qualify a borrower for a mortgage loan. Debt to income ratio. Okay.
So wait, what's a good ratio?
So best loans are, well, for most of us, the best loans are conventional loans. VA loans are better than conventional loans, but most of us don't. Unless you're in Leavenworth, most people don't qualify for those. So the lower the better, right? If you make $100,000 a month and your new mortgage payment is only $1,000, that's a 1% DTI. That's amazing, right? When you talk about qualifying, there's a few different levels. Okay, and we'll get into that. So QM, I want you to write down this term QM. You'll hear this a lot. In fact, I talked to a realtor today and I was telling him the difficulty in qualifying as borrower. And he said, don't we have any non-QM products? QM means qualified mortgage. Qualified mortgage. By the rules of mortgages, and I'll talk just now about conventional loans, a QM loan has to have a DTI under 43%. Now, you can qualify for a mortgage up to about 50% DTI, but there's another way to get QM, and that is to pass AUS, Automated Underwriting Systems. And those are just software that Fannie and Freddie have out there. Fannie and Freddie will evaluate the loan and approve it themselves beforehand if it's over 43 on the DTI scale. So for example, if your DTI is 45, I'd say we can do that all day, but I'd still run it through Fannie or Freddie and they will say approve eligible or ineligible based on other factors besides DTI. So 43 is kind of the magic number for back end DTI, 43 or below, the lower the better. Loan to value, also called LTV. Loan to value. This one's very simple. It's the loan amount divided by the value of the house. Okay, loan amount's pretty simple. That's just a number. Maybe you get a loan for $250,000. That's your loan amount. How do you determine the value of a house? You guys are agents. How would you determine the value of a house? Appraisal's one way. What's the other way? What the purchase price, exactly. Things are worth what people pay for them, right? The bank's going to use the lower of those two. Remember, banks are safe. Banks are conservative institutions. They're gonna go along the safest path. So for value of a home, a bank will use either the purchase price or the appraised value, whichever is lower. Okay, the lower of the two, purchase price or appraised value. This is why appraisals are important. If you're selling a house for $400,000 and an appraiser goes by your house and says, that's worth 350. Guess what? Your borrower wanted to borrow $360,000 to buy that house and the bank says it's worth 350. That's gonna blow up probably, unless you have a buyer that has enough money, you can bring an extra $50,000 and still wants to buy a house for $400,000 when an expert's telling them it's only worth 350. Like I said,
60, they would have to find the extra 10.
so the reason I did 360 divided by 400, that's 10% down, right? So now they have to use the new 350 value. So if he wants to put 10% down, we would only be borrowing 335. Right? But in practice is what happens is your agent goes to the seller and says, hey man, I know we're under contract for 400 grand. But the bank just told me this is only worth 350. So maybe we split in the middle. Can you sell it to me for 375? Or there's renegotiation normally. And there's protective clauses in contracts. That's all stuff you're learning, I'm sure. But that's why the appraisal is so valuable. The appraisal determines the value of the house for lending purposes. The appraisal is for the bank. Yeah, the inspection is for the buyer. And those are different. And a lot of borrowers don't know that. A lot of borrowers think an inspection is an appraisal and an appraisal is an inspection. It's not. The inspection is for you and your client to make sure they really want to buy the house, even after you've looked at the attic and the foundation and all the other stuff. That's the inspection. The appraisal has nothing to do with it. It has to do with the bank saying, is this really worth what they're saying it's worth?
I have a question.
Mm-hmm.
Can we go back to the debt to income ratio?
Mm-hmm.
I mean, like just hearing that people will obtain a loan at 43% makes me like my skin crawl. Because I thought like you have to be, it's like, do you ever advise them that like anything over 35 is like, you're just gonna be house poor, or is that just for the financial planner?
Man, 110 loans we've done here, maybe more than that, 120. I would say 90% of them are over 43.
That sounds.
This is America. We are all maxing ourselves out. Absolutely. This is. Do I advise that?
You ever say?
If they ask those type of questions, sure. I definitely, will say. Like if someone wants to go look at $200,000 houses and I'm having a really hard time approving them at 200, I'll say, hey, you're maxed out here and. And people's feelings get hurt. What are you talking about? I pay $1,900 in rent. You're telling me I can't afford a $1,600 mortgage payment? Well,
Can't go out.
yeah, well, your rent, you can end anytime. You can walk away.
Yeah.
Your mortgage payment, you're in this for 30 years. And if the roof, well, you own it. It's a whole different thing.
Yeah.
And your landlord is not, your landlord doesn't care if you can afford rent. In the way that a bank cares if you can pay the bank back. So it's a whole different thing.
Right, but does a lender care if they're like lending over 43%? That's scary.
Nope. So what almost all banks are really doing is they are funding the loan. And then a month later, they're selling it
Right.
on the market.
Yeah.
They just want to make sure that that loan, that package is saleable. That's what that word is called, saleable. If it's saleable, they don't care. You're,
Did that change occur? Because I know, I'm a lot older than you here. When I bought my first home, we couldn't get a loan if our mortgage payment was more than a third of our income.
Right, that's why.
That was, I remember that kind of being the standard.
yeah, I haven't been in business long enough to know that. I know in 08, everything changed, and before 08, it's kind of the Wild West, and there's a lot of.
Because of.
Anybody could get
it
a loan.
feels
Yeah.
like we shouldn't lend more than 35% because of what happened.
Yeah,
There's a lot, I mean, it's just like insurance, mortgage. There'll be trends, when things happen in the economy or in the market, in the housing market, you'll see. Things happen in lending where. They have different requirements or they
Yeah, so things
drill
change.
down,
Okay.
guidelines change a lot.
yeah.
But there haven't been any real major ones since 08, as far as like these ratios. I mean, there'll be new stuff here, like now you can get an appraisal waiver up to 90%, which is amazing. That happened like 4 months ago. But not, in general, the world got a lot tighter and a lot stricter in 08 because it had to. There were a ton of people that couldn't afford the houses they were in. They were banking on them just going up in value and then cashing them, and then
But it
just,
sounds like it still is that way.
there's,
That's like,
no, there's not a lot of junk paper out there anymore. If you knew how hard it was for people that are extremely qualified to sometimes get a loan. I have a client right now. I think they're on your team. And this guy makes a ton of money. He makes 20,000 as a base, 15,000 in bonus every month. His wife makes like 6 every month plus 18 in commission every month. I mean, they make so much money. But guess what? She got her job in November. And he got his job in November. Can't count any commission, can't count any bonus. Right? So now we're going on just one of their base salaries. And they want to buy a $900,000 house before they sell their other house. And I had to tell them, listen, you're right. I know you can afford this, but we can't use most of your income.
Paper, you don't look.
On paper, it doesn't look as good as it does in your real life. So,
like,
yeah, he's on the border of the other side of this country, which is, mortgages are for us poor people. I went to the beach one time, I remember, and I was like, dude, I was talking to this guy who owned the beach house, and it was huge, and it was in South Carolina. And he was like, oh, you're in mortgages, how are rates these days? I'm like, they're at historic lows. This was way back then. I'm like, people are getting 2% loans. What's your mortgage at? He goes, I've never had a mortgage. I was like, oh yeah, there is that whole other world out there. Right. So at some point you get wealthy enough that you don't need these piddly little things called mortgages that us peons have, right? So anyways, okay, we're gonna keep going here and then I'm gonna get into some fun
Why
stuff
does a bank sell your loan?
because they make money on it.
is it important or does it help to find a lender that doesn't sell?
If, I think it helps to serve your client, and if your client really wants
They
that,
get better rates so they can get better.
no, they get worse rates generally.
If
The
they-
lowest rates are the ones that are competing in that market. The MBS, the market I'm talking about is MBS, mortgage-backed securities market. This is where paper is sold. This is why Fannie and Freddie were created. Fannie and Freddie are quasi-governmental organizations that are out there to buy mortgages off banks. So that the banks are freed up to do more of it. Okay, it kind of greases the wheels in the country for banks to do mortgages. Well, if you're a bank and you're selling stuff to Fannie and Freddie, you're trying to get as many of those as possible, and you're trying to outcompete the other bank. So it brings competition, which lowers rates. There are banks that advertise, we will not sell your loan, we will service your loan, the life of the loan. They are not the most competitive. Yeah, because that's part of that's their money.
Yeah.
And they're given a huge chunk of it, exactly. And they have a limited pool.
It
Right?
doesn't raise your mortgage payment.
That when mortgage servicing is transferred, they cannot change the terms. Yeah. So all it happens is, I mean, anyone in here who owns a house, you get a letter that says your new bank is this, you just go change your automatic payment, nothing else changes. It's not a big deal on the consumer side, but if your clients are interested in it, then that's good. Okay, man, you are right, Kristen, this goes way faster than I thought.
I know, that's
Yeah.
okay, we'll have you back.
Okay, I want to go through the, just the four main types of loans real quick, and then we're gonna do some activities. Conventional loans.
Do you want me to pull up the,
In here in a
Send
minute,
me?
here in a minute, yeah.
Okay.
Conventional loans. Conventional loans are conventional because they are underwritten by Fannie and Freddie. All you need to know about a conventional loan.
They're underwritten by Franklin.
Underwritten by Fannie or Freddie. What that means is, that doesn't mean that Fannie and Freddie have underwriters that are looking at it. What that means is Fannie and Freddie have guidelines, the rules, and they publish those. And the actual bank, whether it's Mutual of Omaha, United Wholesale Mortgage, Capital Federal, NBKC over on Ward Parkway, their underwriters are writing to those rules. They're reading Fannie and Freddie's rules and making sure that your application complies with those rules. Those rules are national rules, and so we all play by the same rules. So lenders don't have better conventional loans than someone else or easier conventional loans. There's no such thing. They can have better rates, they can have better pricing. They don't have relaxed rules. Minimum payment on a minimum credit on a conventional loan is 620. Below that, no go. Minimum down payment on a conventional loan, if you are a first-time home buyer, is 3%. If you are not a first-time home buyer, it's 5%. First-time home buyer does not necessarily mean you're buying your first house. This means you're buying your first house in the last 3 years.
Oh, wow.
Yeah,
Now, I know that.
means you haven't owned a home in the last 3 years. So on a 1003, on a URLA, Universal Residential Mortgage Loan Application, there's a question that says, have you had any ownership at any property in the last 3 years? If you select no on that, you're a first-time home buyer. I had a loan last week, most difficult loan of my life, and it closed, and this guy selected no. And then when we got the title work back, title work had searched his name in the records, and they found a home in Broward County, Florida, where he's moving here. And they said, hey, man, your name's on this deed. He said, I don't own it, in print. Because I asked him, I said, well, hey, there's something wrong on your application. They found a property tied to your name. He replied, I don't own it. I sent it to the lender. And then they sent me the county records. Here's the mortgage note filed at the county with his signature on it that matches his driver's license. Here's the deed filed with the county with his signature on it that matches his driver's license. Need to explain it. I called him, said, Bob, I don't own that house. I said, okay. And I asked the lender, what can we do to prove this guy doesn't own the house? They said, if he really doesn't own the house, he needs to go down to the county and fix the problem. The county thinks he owns the house. And so I called him and he said he held the line, and I called his realtor and I said, hey man, this loan's about to blow up. There's something amiss here. I've run into a ton of problems where people have something wrong at the county, but they want to fix it. And this guy doesn't even seem to want to fix it. I think he's not telling me the full story, man. So anyways, we're not going to close this house unless you can help. So he called me back half an hour later, Bob, I can't believe what happened. That guy was just crying. He feels so embarrassed. Like, dude, we just need the truth. You know, he had a messy divorce 2.5 years ago, and he thought that it was all out of his name. He can't even talk about her. And I'm like, okay, there's the truth. Fine. Hopefully the lender will still go forward with you since you've lied in print now twice to them. And they did. But he had to go down, he had to file a quitclaim deed. He had to go down to the county, he had to get his lawyer involved. He had to do an amazing amount of work to clear his name on there. Well, he should have been honest on the application, and we should have known it 3 weeks in advance. We did clear it. And then when we got his tax returns back from the IRS, they didn't match the ones that he gave us. He made 40 grand less than he said he made. And we had to get that one solved as well. And he did it, still bought the house. It was amazing. I can't believe it closed, actually. But anyways,
Still pinching yourself?
Dude, it was, yeah, still losing hair over the deal. Okay. FHA loans. The FHA loans are underwritten and insured by the Federal Housing Administration. We are scared about FHA and VA loans right now with the lack of federal employees. I think they're going to get harder to do when those offices aren't staffed. They get slower to respond. It's a mess. It's going to be a mess. It was a mess in COVID because the VA wasn't ready for going online, and it took them months before they could return to it. I think this is going to be a mess too. Just a guess, but
You say underwritten and insured by who?
the FHA, Federal Housing Administration. These were designed for first-time home buyers. As such, they allow you to have a lower credit score down to 580 instead of 620. And they allow your DTI to be up to 57.
Oh. And you're gonna protect.
57 on an FHA loan.
Yeah, that is nuts.
It is nuts. It is nuts. It is nuts.
He's 57%.
Well, I mean, hopefully you live with someone who's also makes a bunch of income and they're just not on the application or whatever. Yes, yes.
Yeah.
Honestly.
And then one key thing about FHA loans is they have 2 types of mortgage insurance. They have what's called a UFMIP, upfront mortgage insurance payment. That's at closing. It's a lump sum, 1.5% of the value of the loan. So, you know, on a $350,000 house, maybe like $4 grand, just a straight fee that you pay at closing. It goes away afterwards. You don't get any benefit for it. And you have monthly mortgage insurance. But the monthly mortgage insurance is almost always less expensive on an FHA loan than it is on conventional, especially if you have low credit. So if you're a 625 credit and you look at conventional, your mortgage insurance might be $250 a month. On that FHA, it might only be like $70 a month. So even though it stinks that you have both, you do get a break on the mortgage insurance. You also get a much lower rate. 625 conventional loan, you'd probably be at 8% today with a point or two. On an FHA loan, you'd still be at 6.5. So an FHA loan is a great deal for those who can't or won't qualify on a conventional loan. I have an FHA loan, it's great, it's a 3.5, it's like the best thing ever. I'm not going anywhere. And then finally, VA loans. VA loans are the best. The VA allows you to borrow 100% of the value of the home. And if you have up to 10% disability, you pay 0 funding fee, 0 mortgage insurance. It's a 100% loan. Rates are great. There's nothing better than a VA loan if you have a VA loan.
No.
It's-
Credit score.
There are minimum credit scores, but so the VA does everything different. It does not measure DTI, it measures something else. It's complicated. We don't have enough time to get into it. But yeah, there are credit
But
requirements.
you can only do that for your primary residence, right? The VA.
You can only buy a home on a VA loan as a primary residence. However,
Okay.
if you own a primary home as your, on a VA loan, and then you want to go move and buy a new one, you can buy the new one on a VA loan and keep the old one as an investment property still on a VA
Yeah.
loan. So you can hold more than one VA loan, but you have to buy it as a primary each time.
Okay.
And you're using up VA entitlement, so you can't put as much down,
So
or you
you
don't.
only live for 2 years, move, I mean, I can still be.
You could do 1 year, you could do, doesn't matter the timeline. The timelines are about refinancing. 210 days seasoning requirement on a VA loan to refinance. Okay, we're gonna do some scenarios. Kristen, down, if you could put that up for the people online.
Yes, I can.
Okay, these are actual scenarios that I've seen borrowers in the last month. So these are real deals. I don't know. You guys are together, can you partner up?
You can give it to me and I'll go make copies here in a sec. Or Megan will be nice enough to go.
Okay, so there's a lot to show on these. First of all, just look at page 1. I'm gonna just start asking questions. So this is an FHA loan. There are 2 scenarios. You can see, but this is how our process works. What I'm proving you, I will send you 2 or 3 scenarios like this. The difference between column 1 and column 2, the only difference is the purchase price. You see the difference?
It's also up here behind you.
Perfect. So the purchase price, ooh, that didn't scan very well, huh? Bummer. So what I'm trying to show this borrower is if you buy a $200,000 house. Well, let me ask the questions. First of all, what are the benefits of an FHA loan? We just went over this. What's one benefit of an FHA loan?
You can have a higher debt to income ratio.
Easier to qualify, higher debt to income ratio. Yes, what else? Low down payment, 3.5%, which is a little higher than 3%, but still better than 5%. So pretty low down payment. Yep.
Lower credit, like, is that a part of the saying it's easier to qualify?
Well, but it also has another benefit. It has a lower rate.
Okay.
So even though you might have poor credit, you'll get a way lower rate on an FHA loan. The break point right now is about 700. What I mean by that is if I have a borrower that's set 670 and I price out conventional and FHA money wise is a little bit better when they're below 700. Above 700, conventional is way better. That changes with the market, so that's not a hard rule. That's just something that goes with pricing. What are the negatives of the FHA loan program? If you have decent credit, I would tell you all day long, don't do an FHA, do a conventional if you can. Why? What are the negatives?
Probably need some work on.
The house?
Yes.
Right.
Let's say the house is great for either. What's the negative of just the loan itself?
May take longer to get funded because the government isn't funding.
I don't think they're any slower,
That's just the situation.
money wise.
You wouldn't necessarily be paying the, MI on the conventional, which, I guess, 30%.
Right, but you're on the right track. There's that upfront mortgage insurance payment. You can see that here on total additional funding. So let's look at this scenario here. Look, purchase price is 200. Down payment is 7,000. That means the loan amount should be 193, right? But the loan amount's not, it's 196,372. That's because we've rolled in this additional funding into the loan amount. That's the upfront mortgage insurance premium. In this case, it is being wrapped into the loan amount. Why this one doesn't have Oh, that's conventional, so I messed up on that one, okay. Huh, weird, I don't know why I did that, yeah, let's skip the rest of that one. Okay, number 2. How do I forward it? Oh, just scroll.
Actually. It's a touch screen.
Okay, on the conventional loan, what's the difference between this and those FHA ones we looked at? What do you see right off the bat?
25 or so now. So loan amount?
Yep. There's no mortgage insurance. You look at the monthly payment, all mortgage insurances are 0. Right? You cannot drop mortgage insurance on an FHA, even if you put 50% down, you're still gonna have it. Yeah, so there's no mortgage insurance on a conventional. Okay, let's say that the borrower falls in love with a house that's $290,000. Well, what do you think the monthly payment would be? Bless you. What would the monthly payment be, do you think, on a $290,000 house for this borrower? So we got a monthly payment here, total monthly payment, bottom, 1,803 at 275. We got 1,959 at 300. What do you think it would be if we were at 290? Just a guess.
1850.
Yeah, I think I rounded up to 1,900, but this is what I would show borrowers, and if you have borrowers with us, you'll see these kind of things too. You can use this to get, to extrapolate either way. The difference between the principal and interest and the total monthly payment on option 1, math, if you have a calculator, it'll help at this time. What's the difference between your P&I, principal and interest, and your total monthly payment? What's the monetary difference? What's the total difference?
Within, 400 something.
More than 450? Mental math, no one? 465. What is that difference? So there's 465 different, this is paying back the bank, the P&I. But your bill comes, it's $455 more than that. What is that $465?
Your escrows.
Good, your escrow payment. That's your tax and insurance. This is before we're under contract. Do I know your taxes? Do I know your insurance?
Yes.
No, they're estimated, right? So that can change. This cannot change. The 1338, it's a math equation. But the escrow payment, we're estimating what taxes might be on a house that much and what insurance might cost on a house that much. Okay, total cash to close for a $350,000 house. Here's total cash to close for, oh, it's not even on this. Need to scroll a little bit. Total cash to close on a $350,000 house. Let's say your borrower is very well qualified, but $350,000 houses look better than $300,000 houses, and they really like one. Okay, how much do you think this borrower is gonna need to bring to the closing table to buy that house?
100 grand.
Yeah, pretty good. I like it. It's conservative, about 96 grand. Okay. Okay, scenario number 3. This is pretty, this was a borrower that I showed 3 scenarios that are the same. If you look at 1, 2, and 3 at the top, just like 1 and 2, those have the same terms, but 4 is very different. Why did I include number 4? What goal might the borrower have that I included number 4 for? See if you can tell the difference.
They want to keep more cash.
That's right. What number are you looking at to see that?
10,000 down versus 20% down.
Okay, so rather than looking at all the stuff that goes into the equation, what's the final number that we're looking at? What's that? Well, the down payment's different, but that's gonna lead to, I would caution you not really to talk a lot about down payment with borrowers, because there's more than just the down payment when we're talking about closing. So if you look at total cash to close, look, option 3 and option 4, this is the same exact house, same purchase price. But option 4 only needs $45,000 to close. Option 3 needed $80,000 to close. You have a borrower that's very well qualified, but has $50,000. They can't do option 3. They don't have enough money. They can do option 4. Yeah. What's the bad part about option 4? What does the borrower lose by putting only 10% down, or what's the negative?
Monthly payments higher.
Yeah. Monetarily, what's the difference? What's the difference in the monthly payment between option 3 and option 4? $264, right? So they're bringing, $35,000 less, but their monthly payment's gonna be $264 more. There's a trade-off there, right? But hey, when you love a house, you love a house, you gotta have it, you know how it is. Let's go to number 4. This is different than the first 3 that I did. These are lock options. So when I'm working with a client, there's gonna be 2 rounds of me showing them scenarios. First round is difference in purchase price, like we just looked at. Hey, buy a $200,000 house, this is what it would look like. $300,000 house is what it would look like, because they're still looking around, right? They kind of want to know what it would look like on any of those houses. Option 4 and the rest of these pages are actual lock options. That means the borrower or the buyer is under contract for an actual property with an actual price. So if you look at the top of page 4, you can see that the purchase price is the exact same on all of them. Okay, so what's the difference between 1, 2, and 3? Well, how did we get different interest rates? I mean, everyone would just choose the lower one, right? If they were all the same. There's a difference besides just the interest rate. Someone said it. The points, right? The points are buying them down. So if you look at number 1, you have 7 1/4. This is a few months old. We're way better than that, 7 1/4. And there's 0 points. Well, there's a little bit of points, but there's a lot more points here than there at 6 point. Yeah, I can't even read that.
Blurry.
Yeah, super blurry. 6.99, more points, 6.75. So these are what discount points are. This is how you buy down your rate on a loan.
You could pay cash for those?
They're just a fee at closing, absolutely.
Okay.
But your borrower can pay, or your seller can pay it. You can. Oh, absolutely. Every lender allows discount points for sure. So what we do on these, and we're about out of time, right? I'm gonna do one activity. What we do on these is we talk about the difference between 1 and 2. So let's talk about the difference in cost. Everything's the same except the points. Right? So the difference in points between 1 and 2, I'm just gonna give you the numbers, is $1,879. Okay, option 2 costs you $1,879 more than option 1. Okay, but you get a lower rate. And when you get a lower rate, your monthly payment is lower. So the difference in your monthly payment is $39. So you're paying $1,879 up front to save $39 a month. So what we calculate is a number called the recoup period. The recoup period is how many payments do I need to make before I pay myself back for my upfront investment? Does that make sense? So 1,879 divided by 39. Anyone have a calculator? It's 48.1. So what does that mean? That means in 48 monthly payments, you've saved $39 on every one of them. You've paid yourself back for the amount of points. 48 months is 4 years. So what I will tell a borrower in this situation is, if you think you're going to be in this loan for 4 years or longer, you should buy down. If you're going to be in this loan less than 4 years, you should take this one. And I don't say if you're going to be in the house more than 4 years. Why? Because the average length of a mortgage loan in America is about 4 years. It doesn't mean we all move. It means we're refinancing. So if you think you're going to refinance your loan before 4 years are up, you want to go here. If you don't think you're going to, for one reason or another, you would want to buy down. Okay, see if you can, last thing, see if you can calculate the recoup period. Actually, 5's easier. We're out of time. Recoup period on discount points. I feel like I left a lot on the table. Let's do this again.
Yeah, let's do this. So what I think what Bob shared with you is he told you more than just what the loan products are. He actually took you through some of the process and got you more familiar with some of the terminology and the impact of it. Was this helpful?
Yes.
Yeah, yes. This is what we need, especially as new agents, is to understand. Remember, you guys don't have to be experts on lending and mortgages. But you do need to have base information and knowledge, and then you need to work with experts who then step in. Don't try to play the role of a loan officer, don't. When you get hit with questions, please don't assume it's because you're new.
that you don't know the answer? It's because you just stayed in your brain.
If we have an open house, should we reach out to Louise to make a cost worksheet that we could like?
No, reach out to me.
Reach out to you?
Yeah, yeah,
Okay,
yeah.
and you could
yeah.
make some sort of, like where we.
At least where I will give Parker the right info, and she'll make the flyer, you're talking about
Oh.
flyers and stuff, right?
Yeah, something that we can highlight, like you.
Yeah, I did that for an open house Saturday, and it
Scenario.
sold before the open house started, so they weren't necessary, but.
I have that.